Welcome back, learners. So in the previous session we were discussing about various ratios which are required to check the health of the financial health of the organization or a company. For the benefit of the learners who might have joined us late, I would like to introduce my expert. We have with us Professor V. Saran, who is very learned and very experienced person, and in this session we will be discussing about capital budgeting. So now I would like to request Professor Saran to initiate the discussions on capital budgeting.
So in this session we will be discussing about capital budgeting. It is one of the major decisions in a firm. It's concerned with long-term investment decisions. If you go for making investment, you have various avenues, different avenues for making investment. But in all the investments, in all the avenues, you cannot make investment, because you have to find out where the return is the largest. What is the total amount of investment that you are going to make, and what is the total, or you can say what is the total amount of cash flow that is moving out, and what is the total amount of cash inflows that you are getting over a period of time. If the cash inflows are greater than the cash outflows, that means it is adding to the value of your corporate firm. So from this point of view, you will make decision where you have to make long-term investment, whether you have to produce pencils, or you have to produce pens, or you have to produce sugar, or you have to produce any other thing. There are different avenues, and in all the avenues you will find what is the amount of total cash inflow and total cash outflow over a period of time, because different projects have different lives. Some projects go for 5 years, 10 years and so on. This is known as capital budgeting. So capital budgeting, in short, deals with the long-term investment decisions. It deals with the selection of proposals or projects for making long-term investment. So there are different steps in the capital budgeting. First of all, you identify the goal. Suppose you have already a production base, you are producing pens. So now the question is, in view of the growing demand, you like to expand your operation. So what is the goal? Expansion is the goal. You are producing pens, but you are not very successful. Machines are not up to mark. They are obsolete. You are replacing the old machines to make quality products. So that goal is replacement. In the first case, the goal was expansion. In the second case, the goal is replacement. You do not have security norms, environmental norms, so you have to invest in environment measures that checks the pollution, and for that you have to make investment. So goal is somewhat different. So first of all, you have to identify the goal. What is your long-term goal? And the goal is decided, then you have so many proposals before you. You select one or two proposals depending upon the availability of funds. That means, suppose if you are producing pens, you think it is better to produce pencils. it is better to produce erasers. It is better to produce ink. They are somewhat complementary. Okay. So then you screen only those proposals which are related to the production of pencils, erasers or ink, and you do not take into account all other proposals. Now when you have some basic proposals, 1 or 2, 3 proposals, then you evaluate in which particular proposal the cash inflows are greater than the cash outflows. And if in all the 3 proposals the cash inflows are greater than the cash outflows, then you find out in which the inflows are maximum, net inflows are the maximum. And on that basis you choose that particular proposal, because in that case your corporate wealth will be maximized. So you screen the proposals and then you evaluate those proposals, and after evaluation then the implementation part starts. You acquire the fixed assets, you make investment in the current assets, and you start production. When the production is started, you have some amount of measures of control and some amount of audit. You like to know whether the material is used properly or not, labor is used properly or not, other expenses should be up to mark, not more than that. For that you have standard costing and variance analysis. You set up some standards, and with those standards you compare the actual cost of material, you compare the actual cost of labor, you compare the actual other costs, other payments. If there is some variance, you try to control those variances, and the entire set of steps they come under the capital budgeting. So capital budgeting is a very broad decision that is very fundamental to financial management. So whenever we talk about the proposals, we must pinpoint the different types of proposals. One is known as complementary proposals. What are the complementary proposals? You are producing sugar. Okay. Now you can produce toffee. You are producing pen. You can produce ink. They are complementary, and the total net cash inflow in pen and ink will be more than the sum of cash inflow in pen and the cash inflow in ink. The cash flow in the two taken together will be larger than the individual cash flow of the two proposals or projects. The proposals may be substitute. Substitute means you are producing sugar, but if you take up production of good, a number of consumers will buy good, not sugar. So the cash inflow in case of sugar will come down, the cash flow in good will go up. So the cash flow in one of the branches will be lower, in the other branches will be higher, and they are known as substitute proposals. And lastly, mutually exclusive proposals are there. You have got one go down on lease payments. Now you think that go downs would be constructed. So if you make investment for the construction of go down, the other is rejected, that you have the go down on these payments, that proposal will be rejected, and then only construction of godown means rejection of the other. In mutually exclusive proposals means if you accept one, you have to reject the other. So these are different types of proposals. Now we must emphasize on the cash flow, because the basic concept behind the capital budgeting is that the net cash inflow must be the maximum, or the cash, in other words, the cash inflow should be more than the cash outflow during different periods of time. Why I have used the different period of time means, in the initial period you can call it T0. You acquire machine, plant, you construct the factory, you make the initial investment during the period T0. Then after you construct the factory, you have the current assets, then you start production. So when you start the production, you sell goods, produce goods, you get the revenue, you get some other types of revenue, and at the same time you make expenses on buying raw material, on paying wages to the laborers, on other items. So during T1 to Tn, the lifetime of the project, suppose the project has a life of 5 years. So in the first year, in the second year, in the third year, in the fourth year, in the fifth year, each year you have to find out what is the cash inflow on account of sales and other incomes, what is the amount of cash outflow on account of wages, on account of raw material, on account of other payments, and then you arrive at the net cash inflow during T1, T2, T3, T4, T5. Okay, this is called operating cash flow. Operating cash flow means from T1 to Tn, and when the life of the project is over, you sell the machine is not working now after the 5 years period, so you sell the machine to Kabaliwala scrap as a scrap value, and that scrap value is known as the terminal cash flow, and that arises only during Tn. Okay, so these are the different types of cash flows during different periods of time. Now the question is, because we have to calculate the cash flow during 3 different periods, we have to know how the initial investment during T0 is calculated. We have to know how the operating cash flow during T1 to Tn is computed, and we have to know how the scrap value is calculated. And then only we will be able to know whether the cash inflow is greater than the cash outflow. Normally during the period T1 to Tn, we calculate the net cash inflow. In the initial period T0, there is normally the outflow of cash. We buy plant, machinery, we buy land, building, etc. We have to invest a large amount of money, that is cash outflow during T0, which is known as initial investment or initial cash flow. So what are the items that are included in the initial cash flow, initial cash outflow, you can say? Number one is purchase of fixed assets. You buy land, you buy building or construct building, you buy machinery and etc. So you buy the fixed assets, you acquire the fixed assets. That is a part of the initial investment. You buy machine and get it installed. So installation cost is always there. That is also a part of the initial investment. And at the same time, you train some persons to work on that machine. This machine is very specific. It is not necessary that everyone knows about how to operate the machinery. So you give training to different persons so that they are able to operate the machinery. So training part, the investment or expenses expenses incurred on training of the manpower to make them or to enable them to use the machine is also a part of the initial investment. Then the opportunity cost of assets. You have to buy land for setting up your factory. But suppose you own a piece of land and you use that piece of land for the factory. You do not buy that piece of land, you already own that piece of land and you use that piece of land for the factory. So there is opportunity cost. Suppose the price of the land is 10 lakhs rupees. You do not buy it, you just own it. Had you gone for buying that piece of land for 10 lakhs rupees, but you already own that piece of land, so the opportunity cost of the land is 10 lakhs rupees. If you have a house to reside in, but you do not, you reside there, and suppose you do not reside there, you let it out, you let the house out, and you get the rent. What is the opportunity cost of residing in that house? The amount of rent that you receive is the opportunity cost of residing in that house. So, the same way, it is the opportunity cost of land. You do not buy the land at the present moment, you own that land, but you are using it for the factory. So the opportunity cost of land has to be included there in the initial investment. And lastly,
and that too at the present rate.
When the initial investment is made during T0, what is the price of land? That is the opportunity cost of the land.
Means if that land was purchased 5 years back.
No,
the
current rate
of the land, current cost of the land. We have to take into account.
That. And lastly, because of the fact that you buy the machine, you set up a factory, there is possibility of increase in working capital. For example, you have already a factory for producing pens. You start up a new line of production, you start producing pencils, or you start producing ink. Naturally, there will be larger amount of working capital. So, increase in working capital, increase in inventory, etc. I have just discussed about current assets. That increase, because of your taking up new investment, long-term investment, that increase has to be included in the initial investment. So, what is the formula of calculating? Just look at your computer. It is IO means investment, initial investment during period 0. Because it is cash outflow.
Can you show the slide? Yeah.
Because it is cash outflow, so it is given in minus. So initial investment during period 0 is equal to minus I means cost of acquisition of land, building, plant and machinery. Then you add to it the installation cost. Okay. Then you add to it cost incurred on training of manpower to use that machine, but that is adjusted for taxes. So E multiplied by 1 minus tax rate. Then you add to it the marginal increase in the working capital, and then this much is the initial investment. But for in those cases where you go for replacement of the older machine and you buy a new machine, I have already told you that the goal is maybe for expansion of the output, the goal may be for the replacement of the old machine. So in particular in cases of replacement of old machines, what you have when you have old machine that has a life of say 4 years, and you have bought that machine, old machine, 4 years back or 5 years back, say for 1,20,000. So each and every year you take a part of the cash flow and deposit it in the depreciation reserve fund. Because what happens that when you buy a machine for a huge value, each and every year you allocate a part of the fund as depreciation fund, and after the life of the machine, say 5 years or 10 years, you are able to accumulate certain amount of funds. With the help of that fund, you can buy a new machine. So that is depreciation reserves. So 5 years back, you bought a machine for 1,20,000, and over past 5 years, you have allocated 1,12,000 rupees as depreciation fund. Okay. Now how much you need? Only 8,000. Okay. So the amount of the purchase of the older machine, existing machine, minus the amount of depreciation reserves, the funds accumulated so far, the difference is known as the book value of book salvage value. Okay. The amount of the machine, the price of the machine that bought you 5 years back, minus the amount of depreciation fund is known as the book salvage value. And when you sell the old machine to a kawari wala, a scrap dealer, say for 10,000 rupees, so 10,000 rupees will be known as cash salvage value. So you must distinguish between the cash salvage value and the book salvage value. Clear? Book salvage value is the difference between the cost of the old machine and the amount of depreciation that is accumulated in your depreciation reserve fund. While the cash salvage value is the price that you got for after selling that old machine. So here in case of replacement, long-term investment for replacement, then you add up two initial investment, S means cash salvage value, minus you add, you deduct the, because you have got the some amount of money by selling that old machine, so deduct that amount, cash salvage value, deduct from the initial investment, and then you add the difference between the cash salvage value and the book salvage value adjusted for taxes. So initial investment is equal to minus I minus IE minus E adjusted for taxes minus marginal increase in the working capital plus S cash salvage value minus T adjusted for cash salvage value and book salvage value difference. For better understanding, I like to explain a numerical problem. Numerical problem is that an old machine is replaced. It is a long-term investment for replacing the old machine by a new machine. So you are going to buy a new machine. That means for that you are making investment, long-term investment. So an old machine is replaced. It had been bought 4 years ago for rupees 1,20,000 and is now sold for rupees 10,000. So 10,000 is the cash salvage value. The accumulated depreciation amounts to 1,12,000 rupees. So the book salvage value is 1,20,000 minus 1,12,000 rupees. 8,000 rupees is the book salvage value. The cost of new machine is rupees 2 lakh. The installation cost amounts to 4,000 rupees, and the training for personnel needed for making the machine operational is rupees 5,000 rupees. The increase in the net working capital amounts to rupees 3,000 rupees. The tax rate is 30%. Find out the amount of initial investment. What will be, because for calculating the cash outflow and cash inflow, you calculate the amount of initial investment, operating cash flow and terminal cash flow. So here we are computing the initial investment. So here because it is cash outflow, it will be in minus 2 lakhs minus 4,000 installation cost minus 5,000 adjusted for taxes means 1 minus 0.30, that is expenses incurred on training of manpower, minus 3,000 means increase in the working capital, plus 10,000 because you received the money, that lowers the total outflow on account of initial investment, plus 10,000 rupees minus 30% of the difference of cash salvage value and the book salvage value. It comes to minus 2,01,100 rupees. So now I think it is very clear to you all how the initial investment is calculated. Now we come to the operating cash flow that exists between T1 to Tn, cash inflow on account of sales and other accounts minus the cash outflow on account of different types of expenses. Formula is, because one thing you must be very clear, so incremental cash flow is taken into account. Yeah.
Yeah. Please speak, Bangalore. Bangalore, please speak.
Sir,
Yes,
sir,
please.
just that initial outflow formula was shown.
Yeah.
There one tax rebate was given for some training cost.
Yeah.
Plus some tax rebate was there in the salvage.
Yeah, book
value
salvage
and,
value, difference of book salvage value and cash salvage
that,
value.
what is the funda behind this tax rebate?
Because that is tax, whatever amount is invested on training of manpower, that is a sort of expense, okay, that is sort of expense shown to the tax authorities, and the firm takes advantage of that expenditure that is deducted for taxes, okay. That amount is considered for tax deductions, that is why it is deducted for tax, adjusted for taxes.
Because there are certain provisions,
In that.
for some of the investment there is some provisions for the tax rebates.
Actually.
So for that particular provisions, that tax rebate has been taken into account in that formula for calculating that initial investment. That is the fundamental behind that, logic behind that.
Now one thing, whenever you calculate the operating financial flows, you have to take out so many things, that you do not take into account the depreciation. Depreciation is a cost. Depreciation is an expense. But you do not take into account while calculating the operating cash flow. Because depreciation is an expense, but it doesn't go out of the firm. You have to take into account only those expenses in which case the cash is moving out of the firm. Those incomes who are moving into the firm. So depreciation is an expense which does not move out of the firm. That is why it is not taken into account. Number one. Number two, all the cash flow is taken into account only after the adjustment of taxes. Okay, income adjusted for taxes will be taken into account, because the company has to pay income tax on the profit, and profit is arrived at after taking into account the income. So whatever there is income, of course incremental income or incremental cost is taken into account. Whatever is the income and cost is there, that form a part of the that form the basis of the profit, and if the profit is taxed, so all those figures will be taken into account only after the consideration of taxes. So after tax basis. So now the formula is, show the
Please.
now the formula is marginal operating cash flow is equal to marginal revenue, or incremental you can say, minus marginal expenses minus depreciation adjusted for taxes plus marginal depreciation. Now you can ask, once you have deducted the depreciation and again you have added depreciation. It is because depreciation is an expense, and for arriving at the amount of net profit, we have to show it in the profit and loss account. But because it doesn't move out of the firm, so the cash flow is lower because of depreciation when you show the depreciation in the profit and loss account. But it has not to be a part of the cash flow, so it is again added. It is, once it is deducted and the next time it is added, it is because it has an influence on the amount of taxes. That is why it is once deducted for assessing the amount of taxes, and because it has not to be a part of the operating cash flow, then it is again added to the formula. Now you can have an example. The incremental sales as a result of new investment amount to be 50,000. The incremental fixed and variable cost amount to be 20,000. The incremental depreciation amounts to be 5,000 at a flat rate. The tax rate is 30%. So 50,000 is the income, 20,000 is the cost, 5,000 is depreciation. That's 50 minus 20 minus 5 is 25. 25 is subjected to tax rate. It comes to about 7,500, and it is 17,500, and then you add the amount of depreciation. The cash inflow, net cash inflow is 17,500 plus 5,000, 22,500. This way you calculate the operating cash flow. Now the terminal cash flow, the salvage value, net salvage value is again the same formula that we have discussed. The cash salvage value minus tax adjusted cash salvage value minus the book salvage value minus the you see the removal expenses. Suppose if you sell the old machine to a kabari wala, so you spend some amount of removal and cleanup expenses. That has to be taken into account for calculating the salvage value. And then again there is a net release of working capital, that also you have to calculate for arriving at the net salvage value. For example, a machine was bought rupees 1,20,000. The accumulated depreciation as per the earlier example is rupees 1,12,000 rupees. The machine is sold for rupees 15,000 cash salvage value, which is the scrap value. The removal and cleanup expenses amount to rupees 500, and the net working capital release value is 1,000. The tax rate is 30%. The net salvage value will be cash salvage value 15,000 minus 30% of the difference between the cash salvage value and the book salvage value, then minus 1 minus tax rate multiplied by the removal and cleanup expenses, because you write the expenses, all expenses are subject to tax. It saves taxes. So you adjust those expenses for taxes, and then the release of the working capital, because you cease the production, so that is added, and the net salvage value is 13,550. So what I have discussed so far is that the different steps in capital budgeting, the different types of proposals, and what is the most important is that how the cash flow is computed. Because when you compute the net cash inflow or the cash flow during T0, from T1 to Tn, and the salvage value at the end of the life of the project during Tn, then only you are able to calculate whether this project that you are going to undertake is worth taking or it should be cancelled. So first of all, you calculate the amount of the cash flow, and then you fit those cash flows in some formulas, sub-evaluation criteria, and on that basis you take a decision whether to accept the project or to reject the project. Clear? Now the evaluation criteria are of two types. One is known as non-discounting method and the other is discounting method. What is the difference between the two? Non-discounting and discounting method. If I give you 100 rupees today, and if I promise to give you 100 rupees after 2 years, which one will you prefer? To get it today only. Because future is uncertain, number one. And if you get it 100 rupees today and deposit it with a bank, and at the 10% interest rate, it will be 110 rupees after 1 year, and after 2 years, it will be 121. So, you will be indifferent between two proposals. Number one, you get 100 rupees today, or you get 121 after 2 years. If I say to you that you get 100 rupees today or 121 after 2 years, you will say either of the two proposals can be accepted. Because if I get today 100 rupees and deposit it with the bank, after 2 years it will be 121. So, in both the cases, the result is the same. So, whenever you make investment today in 2007, the life of the project is 5 years. So, in 2008, 2009, 2010, 2011 and 2012, there will be some amount of net cash inflow, revenue minus expenses, operating cash flow. If it is 1,000 rupees in 2008 and if it is 1,000 rupees in 2012 or 2010, it doesn't give the same meaning. It is the value of 1,000 2008 will be much more than the value of 1,000 net cash inflow in 2012 or 2010. So what you do is that you bring those values, cash inflows in 2008, 2009, 2010 to 2012 to the present value. Because you are making investment, you are making the initial investment today. And you are getting the return in 2009 and 10 and 12. So cash inflow and cash outflow during T0 and cash inflow during T2, T3, T4 cannot be compared. So you bring those cash flows in 2009, 10, 11, 12 to the present value, and then you compare the cash inflow with the cash outflow. Cash outflow in form of initial investment. This is the reasoning behind the discounting of the cash flows or the present value of the cash flow. So those methods which are based on the discounting methods, that is a sound reasoning there behind making them or bringing them those values to the present value. They are known as the discounting method, but they are a bit difficult. Not difficult, but they are a bit difficult for those they do not have the idea of how to discount the value. For them, there are non-discounting methods also. So let us first explain the non-discounting method. In this group, there are two types of methods are there. One is known as payback period method. Payback period method, that you have a target payback period.
Yes.
There is a target payback period, that you are making 2,000 rupees investment today as initial investment, and you think that that amount must be recovered within 3 years. So 3-year period is the target payback period. If the amount is recovered within 3-year period, it's okay, you can accept the project. But if the amount is not recovered within 3-year period, the target payback period, you will not accept the project. Even if there is a larger inflow of money, cash flow, in the 4th year, in the 5th year, in the 6th year, in the 7th year, there is continuous inflow of money. But if the initial investment is not recovered within 3-year period, and you have this evaluation criteria payback period method, you will not accept that project. So here is an example in proposal A and proposal B. In both cases, the initial investment is 2,000 rupees, but target payback period is 3 years. So in case of proposal A, the entire initial investment is recovered within 2 years. But in case of proposal B, only 1,900 rupees are recovered within 3-year period, the target payback period. What will be your opinion? You accept proposal A because the actual payback period is less than the target payback period. In the other case, the actual payback period is not less than the target payback period. So you reject proposal B and you accept proposal A. Clear? Now the other method in this group, non-discounting method, is known as the accounting rate of return. You have the net profit, so you have the net profit and you have the average net profit within the lifetime of the project, the 3 or 5 year period. The 4th row is not visible in this one. So the 4th row is not visible, but the average net profit is 800 rupees. And the average investment is about, say, suppose 8,000 rupees. So it is the 10% here. Yeah, now it is seen. Now the average net profit is, per annum net profit is average is 668, and the average investment per annum is 8,000. So it is about 8 point something percentage is the average rate of return. So you have target rate of return, that in this particular industry 8% return rate of return is there in other firms in the same industry, and if we have more than 8% return, we have to accept the project. If we do not have 8% return, less than 8% return, we have to reject the proposal. So in this case, the rate of return, average rate of return is more than 8%, and if the target rate of return is 8%, so there is no question in rejecting the proposal. We have to accept that proposal because the average rate of return, actual rate of return, is more than the target rate of return. Clear? Now, these were the non-discounting methods, the payback period and the average rate of return. These were non-discounting methods. Now we come to the discounting methods. In the discounting method, which is one is known as net present value method, which is commonly used. And you have the formula here that during the period of time, during lifetime of the project, cash flow CFT during T1, T2, T3, T4 are brought down to the present value. Okay? Suppose the discount rate or the risk adjusted, what is the discount rate by which the future values are brought down to the present value? The rate by which the future values are brought down to the present value is known as discount rate. And what is the basis of the discount rate? It is the risk adjusted cost of capital. How is the cost of capital calculated? What is the cost of capital? It is the weighted average cost of capital, because in the capital structure, in the last session I have discussed, there is equity, there is debt. So we have to calculate the weighted average cost of capital. And there is also risk in the market. Larger the risk, larger will be the risk adjusted cost of capital. Lower is the risk, lower will be the risk adjusted cost of capital. It is the cut-off rate. It is the required rate of return. It is the minimum rate of return. The risk adjusted cost of capital represents the minimum rate of return, the required rate of return. It represents the cut-off rate. And that is used as a discount rate. So all the future values are brought to the present values using that particular discount rate. So the cash flow during T1, suppose the discount rate is 10%, the cash flow during T1 will be discounted, will be divided by 1 plus 10%. The cash flow during T2 will be discounted by 1 plus discount rate power to the 2. The cash flow during the T3, third year, will be discounted by 1 plus discount rate power to the 3 in the fourth year and so on. So this formula shows how the cash flows during T1 to Tn are discounted to the present value, and the sum of the cash flows during different years, the present value, the sum of the present value of the cash flow during different years is compared to the initial investment, and that is NPV. So if NPV is positive, you can accept the project. If NPV is negative, what does it mean? It means that the present value of the net cash inflows during T1 to Tn is lower than the initial cash outflow, and that means you are at a loss. You are losing something if you take up the project. So the very concept is clear, that the cash flow during future years, net cash inflow during future years, and the present value must be greater than the initial cash outflow in form of initial investment. This simple example, look at your computer. With an initial investment of rupees 50 lakhs, the net cash inflow during the first, second and third year is expected respectively rupees 30 lakhs, 35 lakhs and 20 lakhs. This is the operating cash flow. 50 lakhs is the initial investment. At the end of the third year, the scrap value is indicated at rupees 10 lakhs. The risk adjusted discount rate is 10%. Calculate NPV. In the first year, 30 lakhs divided by 1.10. In the second year, 35 lakhs will be discount divided by 1.10 power to 2. In the third year, 20 lakhs will be divided by 1.10 power to 3. All of the 3 will be summed up, and then the initial investment will be deducted from the sum of the net cash inflows during the 3-year period, and it is rupees 28 lakhs 73,778. So here the net present value NPV is positive. That means if you take up this project, it is going to add to the value of your corporate wealth. Clear? Now the other is criteria. The other criterion is known as profitability index. The base is the same, the concept is the same. In the NPV rule, you deduct the initial investment from the sum of the present value of the future cash flows. In this case, to arrive at the profitability index, you divide the present value of the future cash flows by the initial investment. So the sum of the present value of the future cash flows in the earlier example, NPV example, is 78 lakhs 73,778.
Yeah. Please speak, Bhopal. Bhopal, please speak. Please speak. If the call is alive,
Hello.
please speak. Yeah, please speak.
In your previous example of NPV,
Reduce
the
the volume.
residual value of 10 lakh rupees has not been considered.
Oh, that has been, oh sorry, that has been considered. Okay, that should have been considered. That has been considered in arriving at the net present value. That it could not be included here in the type. It could not be, in the print could not be included here, but that is there.
This is a typing mistake.
Typing mistake.
Typing error.
Now, here in a profitability index, you divide the present value of the future cash flows by the initial investment, and it is 1.57. So, if the profitability index is 1, what does it mean? It means that the present value of the future cash flows is equal to the initial investment. If it is higher than 1, that means the present value of future cash flows is more than the initial investment, and then you can accept the project because it is going to add to the value of the corporate wealth. Now, the still other method is known as internal rate of return. What is that particular discount rate? What is that particular discount rate which is going to equate the present value of the future cash flows with the initial investment? Okay? Because at 10% discount rate, the two values were not equal. One was 78 lakh something, the other was 50 lakhs. Initial investment was 50 lakhs. The present value of the future cash flows was 78 lakhs at the 10% discount rate. That means if you have a higher than 10% discount rate, say 12%, 13%, 15%, 18% and so on. If you raise the discount rate, at a particular discount rate you will find that the two values are equal. And at that discount rate where the two values are equal, the present values of the future cash flows and the initial investment, that discount rate is known as internal rate of return. So if the internal rate of return is higher than the risk adjusted discount rate used in the market, used in the industry, you can accept the project, because in that case higher IRR is only when the present value of the future cash flow is greater than the initial investment. So you can accept the project. And the last one is modified internal rate of return. Here you raise the value of the cash flows to the present value is raised to the future values. The first year cash flows is raised to the value of the terminal year cash flow, and then on that basis the modified internal rate of return is calculated. So accept a proposal if modified internal rate of return is greater than required rate of return. The same thing is there. In case of IRR, accept the project only when the IRR is greater than the required rate of return or risk adjusted discount rate used in the market or industry. The same is the thing is there. Modified internal rate of return must be greater than the required rate of return if you have to accept the project. Simple example, because time is short now. If initial investment is 1,000, simple example, the net cash inflow during the first year, second year and third year is respectively 500 rupees, 400 rupees and 400 rupees, and the firm's cost of capital, this discount rate is 10%, find out the modified internal rate of return. So you have to calculate the terminal value. So for the first year cash inflow, the 500 rupees is that is 500 rupees multiplied by 1 plus discount rate power to 2 to make it equal to the terminal year's cash flow. The second year is multiplied by 1 plus 10%, and the terminal year cash flow is just, it is just the terminal year cash flow, 400 rupees, all are summed up, it comes to 1,445. So you know the initial investment 1,000 rupees, you know the terminal, the future value of the cash flows at the terminal level 1,445, and on that basis you calculate the modified rate of return. So, and that is here in this example it is 13%. So modified rate of return is 13%, the discount rate of the required rate of return is 10%, so the project may be accepted. So these are the different evaluations. First of all, you calculate the cash flow and then you put it in the evaluation criteria, different criteria I have already discussed, and then you come to the decision whether to accept the project or to reject the project. Thank you very much.
Thank you, Professor Saran, for such a nice presentation in simple words, in a very clear-cut words, and I hope our learners must have been benefited by these presentations and discussions. We are coming to the end of this session, and this is the last session of the day. Before we wind up, I have one important announcement regarding the schedule of teleconference or these video conferencing sessions. There are two changes in the schedule. On 2nd of June, the schedule is as it is, means we will be discussing about IT applications. But on 3rd there is a change. If you remember, in March we cancelled or postponed one session on energy conservation. Now this session is scheduled on 3rd June and energy conservation, And here on this day the expert is Director General of the Bureau of Energy Efficiency. So I think you must attend this session. On 10th of June, this was earlier it was scheduled for the open house, but now the topic which was earlier scheduled on the 3rd June, now it has been shifted to this 10th June, which is IT applications. So for the next 3 video conferencing sessions, the schedule is on 2nd June IT application, on 3rd June energy conservation, on 10th June IT applications again. And I would like to remind you to tell your friends or colleagues who are interested in taking admission in the July 2007 cycle that 31st May is the last date for submitting the application for this advanced certificate in power distribution management for the session of July 2007. So please remind your friends and colleagues that if they want to get admission in this particular course, they should submit their applications on or before this date on the respective regional centers. So we are coming to the end of this session, as well as the day also. There will be no more session on this day. This is the last session. So I hope you must have enjoyed. With these words I wind up. Thank you to all, and thank you, sir.
Okay.